If you only read the headline, you'd miss the most dangerous part. Trump wants to buy Greenland again. That's what they're laughing at. Late-night jokes, smug panels, politicians pretending it's a circus. But while the cameras pan across the comedy, a completely different room is going silent. Not the press room, not Parliament, the risk desks, the vault operators, the bullion banks that keep the global silver market stitched together with logistics, swaps, and just enough physical metal to maintain the illusion of one price. Because buried inside the Greenland headline is something that doesn't sound dramatic until you understand what it touches. A tariff wall, 10% on imports from key European nations, including the United Kingdom, beginning February 1st. And if the deal doesn't happen, 25% starting June 1st. Most people hear tariff and think politics. Silver doesn't care about politics. Silver cares about movement. It cares about pipes, planes, customs forms, and the thin, fragile math that makes 1 ounce in one country behave like the same ounce somewhere else. The entire modern silver market depends on one sacred assumption: that physical metal can be moved cheaply enough to keep prices aligned across continents. London and New York aren't just cities, they're pricing engines. London is the LBMA, the physical nerve center where massive trades settle and where inventory quietly bleeds out to Asia. New York is COMEX, the futures machine, where paper claims set the spot price the world pretends to believe. The system survives because banks can shuttle metal back and forth whenever a fire starts. Demand spikes in New York, they pull bars from London and fly them over. London starts running dry, they ship metal back from New York to refill the shelves, calm the panic, and keep the game moving. That shuttling is not a side detail, it is the lifeline. It's what allows the banks to act like firefighters while quietly controlling where the flames spread. It's what lets them play whack-a-mole with price. If silver starts breaking out, they flood the hottest market with supply, crush momentum, and restore the illusion that the market is deep and liquid. But what happens when you build a wall between the two biggest hubs on Earth? A 10% tariff sounds like a small number until you apply it to a commodity where margins are razor thin and the values are enormous. At around $90 an ounce, you are talking about a $9 penalty per ounce if metal leaves one side and tries to come back. That isn't friction, that's a kill switch. That destroys the arbitrage. It destroys the location swap logic. It turns what used to be a fluid global pool into two separate ponds with no easy bridge between them. And here's the real twist. This isn't happening during calm conditions. London has been bleeding inventory for months. India and China have been vacuuming physical metal off the Western market like it's oxygen. The float in London, the metal that isn't already spoken for, pledged, or quietly encumbered, has been thinning. The vaults still look impressive on paper until you ask the only question that matters: how much is actually available when someone demands delivery? Now place that London reality next to this tariff reality. If you're a US bank, the safest move is suddenly the most brutal one. Stop exporting. Freeze outbound shipments. Ground the metal. Because once it leaves the United States, it becomes expensive to bring back. And expensive becomes impossible when your entire job is to manage risk inside a system held together by tight spreads and confidence. Overnight, the US border stops being a doorway and becomes a trapdoor. Silver can enter, but silver may not be allowed to leave and return without a penalty large enough to turn profits into losses. So while the public is laughing at Greenland, the silver market is staring at a new reality. The bridge between the LBMA and COMEX is cracking. And the moment that bridge breaks, there is no longer a single global silver price. There are only local prices, local stress, local shortages, local defaults. And when that happens, the spot price becomes the least important number on the screen. In the next part, we're going to unpack the mechanism that makes this so deadly. We'll explain why this tariff turns US silver into trapped inventory, why banks will hoard it even if they don't want to, and why the market is about to discover what happens when silver checks in and can't check out. There's a concept in commodity trading that separates amateurs from professionals, and it's one of those ideas that sounds simple until you realize it can destroy a market. It's called the location swap. In a normal world, physical silver doesn't have to move immediately for the books to balance. Banks often swap ownership rights between vaults. You take title to bars in London, I take title to bars in New York. The paperwork moves, and the system assumes the metal can move later if it needs to. It's a financial pressure valve. It keeps the market liquid, even when the real-world plumbing is strained. But that entire mechanism depends on one invisible promise: that moving silver between locations won't punish you. That the cost of moving metal across borders won't be so extreme that it changes the value of the metal itself. That an ounce is an ounce, regardless of what side of the Atlantic it's sitting on. A tariff is the breaking of that promise. Picture the risk manager's nightmare spreadsheet on a Sunday morning. London is screaming for metal. New York has metal. In the old world, you ship 1 million ounces to London, stabilize the LBMA, and you buy time. But in the New World, you have to ask the question that kills the trade. What happens when you need that metal back in New York? Suddenly, it's not just bring it back, it's bring it back and pay $9 per ounce to customs. That $9 doesn't come out of a bonus pool. It comes out of equity. It comes out of the bank's balance sheet. And when you live on thin margins, the 10% penalty isn't a fee. It's a guillotine. That's why the tariff creates what traders call a roach motel effect. Roaches check in, but they don't check out. Silver checks into the US system, and it doesn't check out. Not safely, not profitably, not without a penalty that makes the move irrational. And when a move becomes irrational, it stops. Flow becomes hoarding. Logistics becomes paralysis. This is why the market reaction won't behave like a typical trade war script. Algorithms can model rate hikes. They can model a stronger dollar. They can model industrial demand projections. But they aren't designed to model geography becoming a weapon overnight. They don't understand that the price you see on your screen is built on the assumption that metal can actually move to settle imbalances. Break that, and you're not tweaking a variable. You're rewriting the rules of the game. And before we go deeper, if you want more investigations like this, where we connect geopolitics to the mechanical plumbing of the markets, make sure you like the video and subscribe. It tells the algorithm you want real analysis, not headline comedy, and it helps this channel keep doing the kind of deep dives nobody else has the patience to do. Now, here's the second order effect most people will miss. Even if you never ship a single bar to London, the tariff still changes the price of physical silver in the United States because it changes replacement cost. Silver isn't just a number, it's supply chains, refiners, fabricators, mints, grain shipments, bar production. If the US market relies on European refining capacity or European origin supply streams for certain forms of metal, those flows just got more expensive overnight. 10% doesn't just punish banks, it punishes every participant who has to replace inventory later. So you could wake up and see spot at 90, but the street price, the real price, the price you pay for physical, starts behaving like it already knows the truth. Premiums rise because the market has to price in the new friction. Dealers don't care about political jokes. They care about what it costs to restock and how long it takes. When uncertainty rises, the price of certainty rises with it. That means bigger premiums, longer waits, and a widening gap between paper pricing and physical reality. And that brings us to the most important insight. This tariff doesn't just trap metal, it forces a choice. Banks cannot keep playing global firefighter everywhere at once. They will have to decide which market gets protected when supply is tight, New York or London, COMEX or LBMA. If they try to save both, they risk losing both. Because the movement that once bought them time has now become a one-way door. In the next part, we're going to cross the ocean. We're going to look at London not as a price on a screen, but as a physical market that has been bleeding inventory while leaning on a lifeline that just got cut. And once you see London through that lens, you all understand why Monday morning could be the moment the global spot price stops meaning anything at all. To understand how close this is to the edge, you have to stop thinking of London as a financial center and start thinking of it as a warehouse district with a reputation. The LBMA isn't a theory, it's a physical marketplace. It's metal sitting behind doors, audited in spreadsheets, promised to ETFs, owed to counterparties, and quietly rationed whenever the world gets nervous. London is where the global physical trade has historically felt safe, because London could always source metal when needed. If one vault ran thin, another could supply it. If Asia demanded more, the system would adjust. That was the story. But for years now, London has been draining, not dramatically, not with fireworks, with a steady, relentless pull. India and China treating physical silver like a strategic material, not a speculative trade. That pull matters because silver isn't just an investment metal anymore. It's a critical input for the modern world. Energy transitions, electronics, industrial systems that don't get announced in speeches but still decide the future. When the East pulls metal, it doesn't just buy it, it removes it from circulation, it changes the shape of the market. London's survival depended on an emergency valve, access to the Americas. When things got tight, the system could lean on US vaults, Mexican supply chains, and the deep infrastructure that kept the West's pricing model afloat. But now that valve is turning, not because of geology, not because mines dried up overnight, because a tariff made the trade toxic. This is what a siege looks like in the modern financial world. No tanks, no sirens, just the slow realization that your resupply route is gone. When the London desks open and the weekend narrative fades, the professionals will do what professionals always do. They'll check the books and run the scenario. Can we source metal if delivery demands spike? Can we cover the unallocated liabilities if clients want allocation? Can we maintain confidence if the spread between New York and London widens and doesn't close? Because that spread is the killer. In a functioning market, price differences get arbitraged away. If London trades above New York, traders ship metal to London and sell it, pocketing the spread. That natural pressure keeps prices aligned. But the tariff breaks that pressure. It stops the flow. It lets the spread survive. It lets geography become the price. And once geography becomes the price, London is in trouble. Because London is the side that's already hungry. London is the side that has been exporting metal eastward, reducing buffer inventory, and leaning on the assumption that the West can reshuffle supply when needed. If the US chooses to protect itself, which is exactly what trapped inventory forces, London becomes the market that gets sacrificed first. This is where the unallocated structure becomes dangerous. Unallocated silver in London is essentially a promise. It is an IOU for metal that may or may not be sitting there in a form you can take. In calm times, nobody cares. People treat it like cash in a bank. But in stress, people stop trusting promises. They start asking for the thing itself. They start converting credits into allocated bars. And if enough people do that at once, London doesn't have a liquidity issue. It has a solvency issue. A liquidity issue is when you have assets, but you can't deliver them fast enough. A solvency issue is when you never had enough assets to begin with. The tariff doesn't create the shortage, it reveals it. It removes the escape route. It forces the market to confront the physical limit. Now add the psychology of Monday morning. Traders love narratives until narratives become liabilities. If the world realizes London is isolated, the bid won't just rise because silver is valuable. It will rise because access is valuable. The premium won't just reflect demand, it will reflect fear. A bid driven by fear is different. It does not respect fair value. It respects survival. And while London is being squeezed, New York becomes something else. The most secure pool in the Western world. Not because it has infinite silver, but because the rules are now designed to keep silver inside the US system. That changes how institutions behave. It changes how industry behaves. It changes how anyone with a serious need for physical metal behaves. When supply becomes strategic, the buyers with the most power don't chase paper contracts. They chase inventory. This is why a London spike doesn't stay in London. It infects everything. Banks running global books will see their hedges break. The one price assumption collapses, and suddenly the protective structures they built become traps. They'll be forced to rebalance, cover risk, and scramble for safety. And the only safety in a fractured market is metal you can actually access. In the next part, we're going to talk about what happens when the market opens into this new world. Not a neat gap, not a clean repricing, a structural fracture. We'll look at how this breaks suppression mechanics, how it forces a violent reordering of priorities, and we'll ask the question that matters most. When the system is forced to choose, which side do you think it will save? By the time the first serious bids hit the market, the story will already be outdated. That's the strange thing about moments like this. The real event happens quietly, over a weekend, in a single announcement, in the invisible fear of people who understand the plumbing. Then the public wakes up on Monday and sees the aftermath on a chart, as if the chart created the reality. But the reality came first. The chart is just the bruise. The opening won't be about a single number, it will be about a new structure. Because when you split a global commodity market into regions that can't freely exchange supply, you don't get a normal repricing. You get a fracture. And fractures don't behave politely. They create gaps. They create sudden premiums. They create periods where spot becomes a theoretical midpoint between two broken worlds. The banks will try to manage it the way they always do. Reduce volatility, calm headlines, pretend nothing is wrong. But their tools require movement. Their tools require the ability to shove metal to the location where the stress is greatest. Without that ability, their interventions become weaker, more expensive, and more obvious. The tariff turns every attempt to control the market into a risk event. It forces decision makers to ask, if we send metal now, are we sacrificing flexibility later? And in risk management, sacrificing future flexibility is how you die. So the likely behavior becomes defensive. Hoard domestic inventory. Protect the US pool. Let London absorb the pain. Not because they hate London, but because the US market is the one that threatens their survival if it breaks. A COMEX failure is an American financial headline. An LBMA failure is a European financial tragedy that gets explained away. Institutions don't make moral choices. They make survival choices. That is why the tariff feels like a black swan, not because tariffs are rare, but because this particular tariff hits the exact artery the silver market uses to pretend it's stable. It hits the transatlantic bridge. It hits the suppression workflow. It hits the subtle back and forth that allowed the system to move metal like chess pieces. The instant that movement becomes expensive, the game ends. The board changes. And then there's the reflexive feedback loop nobody wants to talk about. As spreads widen, hedges break. As hedges break, banks reduce leverage. As leverage shrinks, paper selling pressure weakens. As paper pressure weakens, price discovery becomes more honest. An honest price discovery in a market that has been running on fractional physical supply is not gentle. It is violent. It is sudden. It is the market snapping back to reality. The retail investor sees a chart and wonders if it's too late. The industrial buyer sees the same chart and wonders if they can afford to wait. That's when you get the real demand surge, not speculation, but necessity. Silver is an industrial lifeblood. If replacement cost rises, manufacturers don't gamble on dips. They secure supply. They lock contracts. They treat metal like fuel in a world where fuel can vanish overnight. At that point, the market stops being about, should I buy? And becomes, can I get it? That's when premiums detach from spot. That's when the paper market becomes a mirage people reference out of habit, while the physical market sets the real terms. The public will still argue about whether silver is overbought. But the people who actually need silver will be asking a much colder question. Where is it, and can you deliver it? And this is where I want to ask you something that cuts deeper than a price prediction, because the answer tells you everything about where this goes next. If the world is moving toward walls, tariffs, and resource nationalism, if metal is becoming strategic again, what do you think happens to markets that were built on the assumption of endless, frictionless global supply? Do they adapt gracefully, or do they break violently the moment the last easy exit closes? Drop your thoughts in the comments, because this is bigger than 1 week of volatility. This is the shape of the next era. We're not just watching silver move. We're watching the global system change its rules in real time. In the final part, we're going to bring this home. We'll talk about what this means for the long-term structure of silver pricing, why the one global spot price may be dying in front of our eyes, and how to think about strategy when geography becomes destiny. What happened this weekend is the kind of event that rewrites the map without firing a shot. A tariff announcement wrapped in a Greenland headline just exposed the most fragile truth in modern finance. Markets are only global as long as the logistics stay cheap. The moment borders become expensive, assets stop being universal and start becoming local. That shift is subtle in headlines, but it's catastrophic in structure. The silver market that existed on Friday was a single machine pretending to be smooth. London and New York played their roles. The banks moved metal like blood through arteries, and the world accepted a single reference price as if it were law. But the silver market you're stepping into now is different. It's regional. It's segmented. It's governed by access, not theory. The price is no longer just what traders agree on. It's what the supply chain can actually deliver. That changes everything about suppression mechanics. Suppression requires confidence that metal can be mobilized when needed. It requires the ability to dampen spikes by shifting physical supply. But now every shift has consequences. Every shipment becomes a strategic decision. Every export risks turning flexible inventory into stranded inventory. Banks don't like stranded inventory. They like optionality. They like the ability to reverse trades, to rebalance, to move risk away from danger. The tariff attacks that ability at its root. And when banks can't measure risk, they don't become brave. They become conservative. They reduce exposure. They shrink leverage. They step away from aggressive paper strategies that depend on precise hedging. In plain terms, when the game gets dangerous, the people who've been flooding the market with synthetic supply start backing off. Not because they want to help the price rise, but because they were not willing to be the one holding the liability when the physical side collapses. This is the real long-term implication. The era of effortless globalization is fading, and silver is one of the first metals to feel it because silver sits at the intersection of finance and industry. It's money to some people and a raw material to others. In a world of fractured trade, that dual role becomes explosive. The financial market can print contracts. The industrial world cannot print atoms. So how do you think about strategy in that world? You stop worshiping the spot, quote, like it's truth carved into stone. Spot is becoming a reference point from a different era, a midpoint between broken regions. The real number is replacement cost. If you sold your silver today, how easily could you replace it tomorrow? What premium would you pay? How long would you wait? Those answers will matter more than any candle on a chart. You also recognized something uncomfortable. Geographic diversification is not as simple as it used to be. For decades, the global system encouraged you to treat location as irrelevant, buy metal anywhere, store it anywhere, move it any time. But tariffs, walls, and political risk are turning location into a variable again. If a jurisdiction becomes trapped behind policy, your diversification can become a cage. The safest strategy in a world of friction is often proximity, control, possession, access. And that's why the Greenland Tariff, accidental or not, acts like a strategic reserve policy without ever using that phrase. It nudges metal to stay domestic. It makes exports costly. It turns the U.S. system into a place where silver accumulates instead of leaks. That may protect American industry, but it also accelerates global fragmentation. London becomes more vulnerable. Asia becomes more powerful. And the illusion of one unified Western silver market begins to fail. The most dangerous thing you can do right now is underestimate how quickly psychology changes once markets stop trusting their own plumbing. When the public realizes logistics can break pricing, confidence evaporates fast. And when confidence evaporates in a fractional physical system, the rush to safety becomes self-fulfilling. People don't wait for proof. They move because they fear being last. So here's the verdict. This isn't just another headline. This isn't just another week of volatility. This is the market discovering that geography still matters, that borders still matter, and that the metal is not as interchangeable as the paper market pretends. If the transatlantic bridge stays compromised, silver will not be priced as a single global commodity. It will be priced as regional scarcity. And regional scarcity has a habit of repricing violently upward, not because of hype, but because of necessity. Hold steady through the noise. Watch the physical, not the theater. In moments like this, the smartest people aren't the loudest. They're the ones quietly securing what's real while everyone else laughs at the headline. And when the week ahead writes itself into history, you'll understand why the joke was never the point. The tariff was, stay sharp, stay grounded in reality. And if you want more deep dives like this, where we dissect the mechanisms, not the memes, subscribe. Because the next era isn't going to be explained by the people reading headlines. It's going to be understood by the people watching the plumbing.